Okay, good morning. It's Friday. I'd like to just take a few minutes at the beginning to talk about T-bonds. There was some traffic in my office yesterday during office hours, and there seemed to be a lot of questions about Treasury bonds. So I'll address that for a few minutes this morning. Then I have a video to show you that gives you a very good idea of the action on the floor of a commodity exchange, a futures exchange. And you can see why this is such an exciting industry, hopefully, watching the video. That's the idea anyway. So there was a question with regard to the quiz last year where there was a price quote for a Treasury bond, a December bond, and the price was $114.20. Recall that bonds are priced as a percent of par, where par value is 100. The futures contract is based on a bond that has a face value of $100,000 and pays a 6% interest rate. So the futures contract is based on a bond that has a 6% interest rate. The face value is $100,000. Which means if it's a 6% interest rate and if you buy it at par, if you paid par value, which would be 100 for this bond, then you would earn 6% interest because the coupon rate, this is the coupon rate, is $6,000 a year. This is the price down here, and this is the yield. Okay? So we could rewrite this, and we could say that the price is equal to the coupon rate over the yield. So in this equation, the only thing that is constant is the coupon rate. So when you purchase a bond, it pays a fixed amount per year. Some bonds pay semi-annually, but we'll say a fixed amount per year. The yield or the interest rate changes daily, as you know. Therefore, the price will change daily. And there will be an inverse relationship between the price and the yield, because if the numerator here is constant, this is constant, and if the yield changes, then the price must change. And if the yield goes up, then the price must go down. Or if the yield goes down, the price must go up. Yes? Pardon me? Right. The coupon rate is a fixed amount, and of course in the bond market there's a very large cash market for bonds. You can find bonds that pay different varying coupon. That's the standard that the Chicago Board of Trade sets for its contract. Okay? So when you're trading a CBOT contract, it's based on this particular bond. So if the price is trading at 114.20, that means 114.20 of par, which means that the price is above par value. In other words, the yield is below 6%. And we know that interest rates today are below 6%. So if the interest rate falls below 6%, if the interest rate falls, then the price must rise. And so the price in that example was 114.20. The 30 seconds is just the convention that's used for determining prices of bonds. And each 30-second is worth $31.25, as I explained the other day, because if you divide $1,000 by 32, you get 31.25. So each basis point here is worth 31.25. Do you understand this equation? Because this is critical for understanding the inverse relationship. Some of you seemed a bit confused, trying to decide whether you should go long or short based on your interest rate expectations. I can give you another example maybe to help. Let's suppose that, well, we'll keep the coupon at 6,000, okay, because that's fixed. So if the coupon rate is at 6,000, and let's say the yield is at 0.04, so it's 4%. So that's the yield. That's the coupon value. And remember, that does not change, okay? This will give us a price of $150,000. $150,000. Because the interest rate has dropped below 6%. It's gone from 6 to 4. This is constant. So the price will rise up to $150,000. So you need to understand that basic relationship. We're not going to dig into bond pricing in a comprehensive way. Basically, you need to understand that when interest rates go up, price of bonds fall, and this is the reason. And you must be able to determine your profit or loss from a price change. In the example from last time, the price went from 114.20. Let's see, find an eraser. The price went from 114.20 to 115.02, and you were asked to calculate the profit or loss. Well, you simply take the difference between the two. So this is 115 2/30 seconds minus 114 20/30 seconds. So this would be 114.34 30 seconds minus 20/30 seconds. So that gives us 14/30 seconds, or the term is 14 basis points. That would be the price change. We multiply 14 by 31.25, and that gives $437. Okay? So if I ask you a question like this, I might ask you to also account for a commission fee, brokerage fee. You're paying those in StockTrack. That's just a one-time fee. You pay a fee for getting in and getting out. You don't pay it twice. You just pay it once. Okay? And of course, if there's a loss, you have to add it to the price. Right? In this example, this was a loss. So you'd have to add your commission fee, which would take the total up to $487 if it was $50. If it was a profit, of course, you'd subtract the commission fee. Any questions on how to calculate profit or losses for a long-term Treasury bond? Okay. I guess the only people who didn't understand it came to my office yesterday. Yes? Sure.
I don't understand why you do $1,000 over 32 to get to 31.25.
Okay. I was just trying to explain where the 31.25 comes from, because it almost sounds like it's coming out of nowhere, right? So the face value of the bond is $100,000, okay? So 1% of that is 1,000. And these prices are percent of par. So if it was a full basis point, it would be 32/30 seconds, which would be $1,000, because it's always a percent of 100. So we're just taking 1%, and then it's priced in 30 seconds. It turns out the options are priced in 64ths. Okay, so then we end up with $15.62 on the options. But it's just a convention that's used for bonds. Okay? You're welcome. Yes?
Can you explain why it's a loss?
Okay. Yeah. Well, it's a loss because you went short and then you bought. Okay. Whenever you, yeah, right. Exactly. So on the quiz today, there'll be some questions like this. Please show your work. We mentioned that on the question. Don't just write down a couple of numbers, 3 or 4 numbers, and then move on, because it will be impossible for us to tell whether you intended to go short or long. Because half of the problem deals with getting on the right side of the market. So you must write down whether you're short or long initially, at what price, and then you reverse your position, you calculate your profit or loss, and deal with your commission fee. So whenever you're buying at a higher price than you're selling at, you're going to lose money no matter what. Okay? So another way to check your work is when you look at this result, it's 1430 seconds. You know it's less than $1,000. Sometimes, we'll get answers that are, tens of thousands or hundreds of thousands. So if the price goes from 114.20 to 113.20, well, that's easy. That's 100 basis points, so that's $1,000. So if this is more than 100 basis points, it's more than 1,000. So if it's 1 dash something, then you know it's between 1 and 2,000. That's just another way to check your work. Yes?
You were saying about commission fees, you only pay it once. You go along and then you end up selling, you just pay the...
Yes. Right. Yeah. Kristen?
I'm confused how you said 100 basis points totals $2,000. Wouldn't you multiply it by 31.75?
Right. But it's 32 times 31.25. Okay? This is equal to 32 30 seconds. You do, but I mean, looking at this, you know it's 1,000. So, okay. But usually I won't give you a nice simple example like that. But it's just a way to check your work. So if you're coming up with a number that's, you made a profit of $60,000 and the price change was, 1-13, well, something's wrong, right? You know that it's between $1,000 and $2,000. So you shouldn't have an answer that's 60,000, okay? Do you have a question? No? Okay. Anybody else? I'd encourage you to try trading bonds on the stock track game. They're back up today. Of course, I'm waiting till they get back up to where they were last week because I didn't sell when I wanted to, but we'll see what happens. They're creeping back up again. The market's been very active the last few weeks. Basically, the market's trying to judge whether the U.S. economy is actually strengthening or not. Yes?
Euro, dollar work the same way with interest rates?
No, it doesn't. So the question is, how does the euro dollar work? We're getting ahead of ourselves a little bit, but I'll try to answer your question. And we'll come back to it in Chapter 4. But the euro dollar, remember, I've emphasized the fact that there's a difference between the euro and the euro dollar. Euro is a single currency. Euro dollar is short-term interest rates based on dollar deposits in overseas banks. So there's lots of US dollars that are parked in overseas banks. Because the dollar is recognized as a global currency, a lot of transactions are conducted in dollars. If you have 2 third countries, if Kazakhstan exports wheat to Turkey, chances are they'll be paid in US dollars. So there's a lot of dollars floating around outside of the US. There's a short-term interest rate that's quoted in London every day. It's called the LIBOR, the London Interbank Rate, and that's what the US dollar interest rate is if you're in an overseas bank. So that's the euro dollar. So your question is, how does it work in terms of the futures? Well, first of all, the face value on the euro dollar is 1 million. Okay. It's 1 million, and the price quote is is 100 minus the interest rate. It's 100 minus the interest rate. And I think we mentioned this the other day when we were looking at the Wall Street Journal. There was a price for a nearby contract that was 98.86. This was the price. So that implies that the interest rate was equal to 1.14%. Very low, short-term interest rate, 1.14%. So again, you have an inverse relationship between the interest rate and the price because the index is 100 minus the interest rate. So if the rate goes up, then this price goes down. And to calculate a profit or loss, now, as I said, we're getting ahead of ourselves, but I'll just mention it. But I'll come back to it later. The profit or loss, you take the price, let's say 98.86, and let's suppose the market moved down to 97.86. Okay, so that's 100 basis points, and that equates to $2,500. I know it's confusing because it's different than bonds. Each basis point with Eurodollars is 25 bucks. Each of these points right here, if it goes from 98.86 to 98.87, the change is $25. Why is it $25? You have $1 million face value. 1% of $1 million is $10,000. 1% of $1 million is $10,000. The Eurodollar contract specifies a short-term interest rate for a 90-day deposit. That's a quarter of a year. So it's a 90-day deposit, so we have to divide the 10,000 by 4 quarters in the year. So you divide the 10,000 by 4, that gives you $2,500 for a 1% interest change. Okay? So if I lent you $1 million for a year, and I charge you 1%, you'd have to pay me $10,000 interest. If I lent it to you for 90 days, you'd pay me $2,500 interest. Or if the interest rate changed by 1%, and you were going to pay me whatever the rate is at the end of the loan, if the rate jumped up 1%, your cost would be an extra $2,500. So that's where the 25 comes from. Does that make sense? Okay. But I won't ask you this today. Okay, we'll save that for the midterm. Yes?
When I was doing my trading on stock track, I
Yep.
bought one of the index futures.
Uh-huh.
And I was confused about the pricing on those because it just said like 5,000 or something. And then I tried to buy like 10 of them, and then
You didn't have enough money?
I don't know.
Yeah, no, the margin calls are really high. I'll tell you what, on Monday I'll go over the index futures, okay? I want to get some of this video in. Is nothing coming up?
it's IBM ticking down or if it's Microsoft ticking up. He's going to make his decision whether he's going to buy or sell that order based on what he sees or feels.
Buying these, how many?
In a routine day, I'm sure there's a lot of guys here who, you know, maybe 25, 50,000. Good day, yeah. 1,000 or 2,000 ticks, sure.
You make the decision to buy or to sell. No one tells you to do it. No one makes you do it. It's your money. If you're right, you know, you win. If you're wrong, you lose. I mean, it really is democracy.
Markets are objective. You put your monies up and you say you take your chances and you reap the rewards and you reap the punishments. At the end of the day, they don't care, again, who you look like or what you are. If you're right, you're right. And that is a beautiful thing.
We're here trying to function in this system, and it's a good system because this place is, we're about economics, we're about numbers, and that's okay. That's not a bad thing inherently. You go to college, you get a degree, you know, you come out, you get this great paying job, you buy a house, you buy a car, you get a wife, and you're on your way. You got the American dream going. And I was in pursuit of that dream. Still am, going where the money is, literally and figuratively. One of the reasons I'm here is because there's no ceiling on my income.
A lot of people think this is a really easy way to make a lot of money, and unfortunately, not only is it not easy, it's very difficult. Most people trade at least 100 at a time. There are a number of people who often will take over 1,000 at a time. It's $25 a tick. If you did 1,000 contracts and you made one full tick on them, that's $25,000.
You must be trading euro.
But it's also $25,000 if you lose a tick. You can easily lose in a day more than you made in a year.
I sold 17 at 1.5. The bales I filled at 1.
First of all, you can't even think of it as money. It's like an athlete thinking about getting injured. You know, if you do that, you're going to get injured.
The market opens at 7:20. A lot of times by 10 o'clock, 10:30, 11, a guy's up, you know, $3,500, $5,000. He'll leave for the day.
Sometimes somebody will trade literally $1 billion on a card. You know, because they will do 1,000 contracts, which is $1 billion. $1 billion can be on one card.
You have to remember it as if it was your name because of what? I need you to know, as my hands move, you're able to say what you see. What do they say?
Fast forward here.
We're in the United States. Every guy in that cattle pit may have traded that any number of times. In the bigger picture, we save money. Essentially, your Big Mac may only cost $1. I can't say that it cost $2 without us, but I know it'd be more than $1. There's no question. If we weren't around, your Big Mac would cost $1 today, $3 tomorrow, 50 cents next week. And I don't think that's in the best interest of most of the people in our society. The lifespan of a steer may be a year. They're little cows running around in a pasture somewhere. And essentially what you're trying to figure out is what the cattle producer is going to be thinking, or what sets of facts he's going to be dealing with in a year from now. That could be the economic trends, the price of money, interest rates, demand of the public. You know, there's 1,000,001 factors that go into making up the price. You know, most of the people who trade this stuff, that's what they're trying to figure out. They're trying to take all this data input and figure out what the price is going to be later on. I make my living on tiny fluctuations and blips in prices. I may hold a position for a half a second, you know, turn stuff over constantly. A 100-point fluctuation is enormous. That's a tenth of a penny. 7 on 20. The contract specification is for 40,000 pounds of live cattle. And if in fact you kept your futures contract through expiration, you would have to take delivery of 40,000 pounds, which is roughly 40 head of cattle. They don't want to make or take delivery. That's not what they're in it for. They're in it for whatever their own personal reasons might be, but delivery is most definitely not one of them.
It's all noise, but it's not. It's like any other business. It's a language. It has a language of its own, and once you are able to discern what's important, you don't hear noise. You hear variations on a theme that you're looking for, and you try to play on that.
If you're first generation and you come from a background where your parents really had nothing, money gives you some security. It actually gives you a little bit of political power, things that you might not think of, but are very, very real to somebody like myself. There are a lot of people on our floor in our business that are first generation. You end up with a chip on your shoulder, something you have to prove. And I think money is just part of that. It's the only place in the world where you can come down with nothing, you know, and work your way up just through sheer hard work, determination. You know, I've got cousins down there that barely got through high school, that worked on a farm, and are making millions of dollars as locals.
90 on 30. 2 on 20. 1 and 2. 1 Justin, 2. 1 card, Jeffrey. 2 sale. I sold you 1 tax. He knew you. Yeah, got it. 905. 30 for 100. 30 for 100, Jay. Spread. 60 on 5. 60 on 1. 60 on 1. We, in the cattle pit, we pride ourselves on being a gentleman. It's sort of an older crowd. Most of the guys in the pit I've known for years and years. I've traded in the pit full-time
for 15 years, and I had part-time even before then. Barney and I have known each other since like the 3rd grade. That was sort of how I got into business. You know, Barney's dad was down here and came from the Chicago stockyards to the pit, and then we sort of came down here as a summer job, as a fluke. You know, I've sort of been here ever since by default. I've been down here a long time. It's funny because I always say I grew up down here. I started down here when I was 18 years old, and it's a weird place to, the value systems are distorted, and you have to be careful. You just really have to be careful. It can be really problematic for a person's life. You give a 25-year-old guy a ton of money, and it creates some serious problems. And my hope is that over the years I've matured, because it's a difficult place to mature in. You're rewarded to a certain extent for immature behavior. Sometimes it reminds me of a big high school locker room. There's a bunch of us guys, and we're all victims of arrested development. Or else we couldn't stand in the pit every day and kind of take the risks and do the things that we do. You put 30 guys together anywhere, and I think things sort of sink to a pretty low common denominator. And you know, and I say that without, I'm not embarrassed with that. It's fun. We have a good time. In the heat of the moment, what to an outsider may seem as anger or whatever is more, in my, at least in my personal case, it's concentration. I have to focus on what I'm doing. And for me, I try to listen to 3 different crowds. Most of the time I can do it. And so I don't want to hear anything else. And it's people think I'm angry, and I'm not. I'm just paying attention. Over the years, my worst losses and biggest losses, and they've been enormous, have been generally when I got pissed about something. Or else I take something from outside the pit into the pit, and that'll kill you. It'll just eat you alive. I've spent years reflecting on those moments, and you can refine it down to that one instant where you said, I fucked up. And at the time, you're not even aware of what's kind of happening, and the repercussions are astronomical. So that's one of the reasons why I